Hello and welcome back to the Smile and Save podcast, brought to you by Serve and Protect Credit Union. Now today's episode is all about financial resilience, but in particular about how to improve your financial resilience and give yourself the best possible chance of dealing with a financial emergency whenever it happens throughout your life. Now just a quick reminder before we get started, if you haven't already, if you could follow or subscribe to the podcast to stay up to date with our latest episodes. And if you are able to, please leave us a 5-star review, as we really appreciate it and it'll really help us out. Now, as I say, today's all about improving your financial resilience. But if you're not quite sure what financial resilience is, after this, head back to episode 2, where we talk all about financial resilience. We explain what it is, why it's important, and some of the things that may test your financial resilience. We'll do a quick recap on that before we start. But for more detail, do head back and check out that episode as well. So let's get started. So as I said, let's do a quick recap just on what financial resilience is. So financial resilience is defined as your ability to withstand life events that may impact your income or your assets. It's all about dealing with financial emergencies. Now, this can be something that increases the amount of money that you spend or decreases the amount of money that you earn. And there's a couple of key examples that always tend to come up when we talk about financial resilience. The first one is health issues. So that could be yourself or a loved one. And with that, there could be additional expenses related to your healthcare, or you may be out of work for some time, so earning less money. Secondly, we've got job loss. So if you lose your job, you've obviously got less money coming in as a household, but you've probably still got a lot of the same bills to pay. And the third one is relationship breakdown. So whether there's someone that you're married to or just living with, if you're kicked out of the house, you've got to find a new place to live. And if you're kicking the other person out of the house, well, there was 2 of you paying the bills, and now it's just yourself. Now, these are just 3 examples. There could be anything that tests your financial resilience. Now, these are just 2 examples, but there can be lots of different things that test your financial resilience throughout your life. It could be your car breaking down, your boiler packing up, anything that's going to impact you financially that you're typically not expecting. Now, why is financial resilience important? Well, having good financial resilience can help you to quickly recover from financial setbacks. And it means that you don't actually end up in a worse financial situation. And you'll find with a lot of people who experience financial difficulties, it comes from not being able to deal with a financial setback. So giving yourself the options to turn to can really help you to recover and move on back to where you were to begin with. So if you were to experience a financial setback, there's a couple of different things that you could do to be able to deal with it. And typically the best option is turn into your emergency savings. Now, there's a couple of reasons why turn into your savings is a great first option. The first one is that your savings are immediately available. So if you were to experience a setback, having your savings there ready to go can help you to deal with it quickly. But in addition to that, it's actually a really cheap way of dealing with financial emergencies. And that's because you don't pay interest on your own savings. You actually earn interest. So by saving over time and earning interest on those savings, you can then use your savings to deal with that emergency without paying for them. Whereas other options are going to cause you to pay interest, and we'll get onto that in a second. But what happens if you don't have those emergency savings already? Well, you may have friends or family members who are happy to lend you a small amount of money to deal with that expense, get yourself back on your feet, and pay them back when you can. Now, this is a good option as well because you do not necessarily have to pay interest on that money and it won't affect your credit score. However, not everyone is fortunate enough to be able to have friends or family to borrow from, or you may not want to for various reasons, and that's fine. But in that situation, you need to know what your options are when it comes to borrowing elsewhere. And there's things that you can do now to give yourself the best chances of borrowing affordably and getting the best deal for you. Now we'll get onto the things that you can do to give yourself a better chance of borrowing in just a minute. But to begin with, because it's the best option for you, let's talk about how to build your emergency savings and if you struggle to save, some of the things that you can do to save more money every month. So, if you're looking to start saving for your emergency fund, maybe it's something that you've not done too much of before, or maybe you've tried to save and you find it really difficult for various reasons, a great place to start is actually by doing a budget plan. Now, you've probably heard of a budget plan and it has different connotations, but a budget plan basically just means looking at how much you earn and how much you spend. And why is this useful? Well, before doing a budget plan, you probably guess roughly what you spend every month, whereas a budget plan will tell you exactly where you spend your money and give you a good idea of your financial habits and some of the things that you can actually change to improve your financial situation overall. Now, a budget plan can be as simple or as complicated as you want it to be, but there's a couple of different tools that you can use to create one. You could create your budget plan in a spreadsheet. You could do it on a scrap of paper or in a notebook. You could use an online tool, or you could even use your notes page in your phone. To get started, all you need to do is gather your financial information. Now, all you typically need is how much you earned last month and everything that you spent money on last month as well. Now, a good way to do this is to get your mobile or online banking, or maybe even your bank statements, and have all that to hand ready to go. Now, once you've got all that information, all you need to do is write down what you earned last month and then note down every single purchase that you made. So you'll need to write down the total cost of each purchase, what that purchase was, and where you spent it. So for example, let's say you bought a takeaway coffee, you put down the total cost, maybe £3 or £4, what that cost was, so takeaway coffee, and if you want to, you can also put the company that you bought it from. So once you've done this for every single purchase, it's a really good idea then to categorize each purchase that you made. And you can do this in a few different ways, but the bare minimum is to categorize each expense as either a need or a want. And we'll do a really detailed episode on budgeting in the future, so we'll get into this then. But all you need to know for now is that a need is typically things that you need to spend your money on to live a healthy life. So for example, this could be your mortgage repayments, or it could be your rent, food shopping, transportation costs, all those things that you have to buy. Whereas your wants are the things that you enjoy spending your money on. So it could be entertainment like Netflix or Disney Plus, going out at the weekend, treating your loved one to a meal out, things that we enjoy spending our money on. Now you can break down your spending even further if you wish. So within your wants, you could break them down on entertainment or holidays or whatever it may be. But as long as you've categorized by needs and wants, that's all you really need to do at this stage. Now, the reason that we're splitting our spending into needs and wants is so that we can understand the things that we need to carry on spending our money on, and some of the things that we could cut out in order to save more money. Now, there's a couple of different budgeting methods that can help you to prioritize where your money goes every month. And one that we really like at Serve and Protect is the 50-30-20 rule. And this budgeting method basically just splits your spending into different categories. So the 50-30-20 rule basically says that about 50% of the money that you earn every month should go towards your wants. So again, it's your mortgage or rent, food shopping, transportation, your bills, all that sort of stuff. Then about 30% of your income should go towards your wants. So the things that you enjoy spending your money on. And then ideally, you're going to have about 20% remaining to save for the future. Now, this could be actually saving for different savings goals, or it could also be paying off debt early in order to give yourself more money to save every month. Now, the 50-30-20 rule isn't a golden rule, and it's not something that you have to stick to completely. And that's because everyone's financial situation is slightly different. You may be listening to this and thinking that 20% of your income saved every month is quite achievable. Maybe you're still living at home, you don't have kids yet, you don't have too many monthly expenses that you need to pay for. And in that case, you can probably afford to save a lot more than 20%. However, if you do have a lot more monthly expenses, and you do have, for example, a mortgage and kids and lots of different things that you need to pay for, 20% might be a bit of a challenging savings target, and that's absolutely fine. But the beauty of the 50-30-20 rule is that you can make a change in one area to also make a change in another. So your needs typically won't be able to change too much. You can't just stop paying your mortgage or not buy food. But your wants and your savings are almost a little bit like a seesaw. If you decrease your wants, you can increase your savings and vice versa. So when it comes to your budget plan, having a look through your wants and looking for anything that you maybe regret spending money on, or something that you could cut out, such as takeaway coffees, takeaway food, maybe alcohol, and look for cheaper alternatives can help you to decrease your wants and increase your savings for the future and for your emergency fund. Now, the 50-30-20 rule is one way of budgeting your money. Another really good method is called the pay yourself first method. Now, for a lot of people, when you first start saving, you may spend whatever you need to throughout the month, then get to the end of the month, and whatever you have remaining, you put into a savings account. The problem with this is that the amount that you save every month depends on how much you spend. And that means that you're saving a really inconsistent amount of money every month. And so it can be hard to plan and prepare for reaching your savings goals. So by flipping that and actually saving money as soon as you get paid and then spending the money that you need to throughout the month means that you can spend your money a little bit more guilt-free because you've already done the hard work of saving. And it means that you can save a consistent amount every single month to help you reach your savings goals and prepare for when you're actually going to reach them. Now at Serve and Protect, we provide a really easy way to do this through something called salary deduction. So if you work in the police, prison, military, fire or health services in the UK, and we've partnered with your employer to set up salary deduction, it means that you can actually save direct from your salary, which will be taken before you receive your wages. So it makes saving automatic in the background, and it makes it almost impossible not to save every single month. So if you work in one of those services and you want to learn a little bit more, head to www.serveandprotectcu.co.uk. So let's say you've done your budget plan, you've cut out some things that you maybe don't need and started to save a little bit more for the future. How much should you actually save for your emergency fund? Now, there's a few different theories on this, but Money Helper recommend having at least 3 months of essential outgoings saved in an easy access savings account. Now, what does that mean? Essential outgoings are just things that you need to spend your money on, so it's your needs. It's your rent or your mortgage, food, all that kind of stuff. And it's important to be in an easy access savings account because when financial emergencies arise, you need to be able to access that money to use it to pay for that expense. Now, the benefit of having 3 months of essential outgoings saved in your easy access savings account is that, let's say, for example, you lose your job and it takes you a couple of months to find yourself a new job, start the job and get paid. It means that for that whole time, you don't have to worry about paying for all the things that you need to pay for every month. And it means you can focus on just getting yourself back on your feet and your finances will work in the background for you. It also means that you don't have to dip into your savings for other goals. So if something happens to you and you need some money to be able to deal with that expense, you don't want to be dipping into your retirement fund or your savings for your next summer holiday because it's going to take even longer to reach those savings goals. So that's a fairly quick run through of how to save a little bit more money every month and how to actually save for your emergency fund and some of the things that you're looking for in that account. Next up, we're going to be talking about how to improve your chances of borrowing affordably if your savings aren't quite enough to meet your financial emergency. So if we go back to what we said at the start of the episode, if you experience some form of financial difficulty, your savings are always the best place to start. However, your savings aren't always going to be enough to cover big financial emergencies. And if you experience something particularly difficult to manage, then you may need to borrow money. And your first thought of where to borrow from is probably a bank. You're likely already saving with a bank, you may have a current account with a bank, and so it makes sense to look to them first. However, it's important to be aware that what you see is not always what you get when it comes to the headline rates of banks. Now, this leads me on to something called iceberg loans, and this is a trend that was researched a few years ago by the Times, and it looks into the headline rates of banks and how accessible those rates actually are. So a headline rate is basically the lowest rate that a bank can legally advertise to borrow money. And so it's often advertised on TV, or you may even have emails offering you a certain rate. Now, the way that this works is that the bank will advertise that rate and people will then apply for it. And so when people apply for the rate, the bank will then do a hard credit search in their name to figure out if they're eligible for that rate. And then they will decide if they're actually eligible. Now, for the bank to legally advertise the headline rate, they only have to actually offer it to 51% of people who apply. Now, that 51% are typically people with a really good credit score and a credit history that has nothing on there that the bank is really worried about. However, that means that there's at least 49% of people who aren't eligible for that rate. So what happens is they're typically offered a much higher rate of interest, often upwards of 10% APR higher than what was originally offered. And this is difficult for people because they've applied for this rate, they've had a hard credit search done in their name, which temporarily reduces their credit score, and they're now in a position where they have to decide between paying much more than what they expected to be able to deal with that financial emergency, or turning elsewhere, having another card credit search done, and trying to borrow from someone else. So let's say you've got a financial emergency, your savings aren't quite enough to deal with it, you don't have friends and family members that you can turn to borrow, and the bank won't lend to you at an affordable rate. If you're in that situation, what actually is your next alternative? Now, unfortunately, we've seen, particularly over the last 10 years or so, that next option has been payday lenders. Now, if you've never heard of payday lenders, they typically offer small amounts of money over a short period of time at particularly high interest rates. Now, the main thing that makes payday lenders appealing for people is that it's quite easy to apply and it's quite quick to be approved. However, there's a large financial cost that comes with that. Payday lenders can often charge hundreds of percent APR to borrow money. And not only is that expensive in the short term, it can also impact your future borrowing options as well. Particularly if you're looking to take out a mortgage, payday loan usage can actually stay on your credit report for up to 6 years. And mortgage providers in particular may worry about lending to someone with payday loan history on their credit report because it can indicate poor money management. So you may be wondering what the alternative is. And credit unions actually provide a really good alternative to high interest credit such as payday lenders. This is because credit unions in the UK are actually capped at the APR that they can charge people to borrow money. And that cap is 42.6% APR. You'll actually find a lot of credit unions charge significantly lower than this, for example ourselves at Serve and Protect, and you can find more information on our rates on our website. Now, not only can borrowing from a credit union be much cheaper for you, they're also a really ethical way to borrow as well. And that's because credit unions are actually not for profit. And so the profit that they do earn is used to provide a savings return back to their members and also support charities and good causes within the communities that they serve. So you may be wondering why people don't just go to credit unions in the first place. And that's because a lot of people in the UK, unfortunately, aren't aware of credit unions and the support that they offer. So if that's yourself and this is the first time that you've heard about a credit union, head back to episode 1 of the podcast where we talk all about credit unions. We explain what they are, what the benefits are of joining, and also what makes them different from other financial providers. We also talk a lot about this in episode 3 of the podcast, which is our first video episode. So be sure to go back and have a look at that on our YouTube channel as well. So we've talked a lot about your credit score and your credit report, but if you've never done it before, it's important to know how to actually check your credit score. Now, there's a couple of options to do this, and some really good places where you can do it are ClearScore, Credit Karma, and Experian. Now, they're all going to give you similar information, but the actual number for your credit score might be slightly different with each provider. Don't worry, this is just because they use different algorithms and different models to calculate your score. But each one will typically rank you somewhere from poor to excellent when it comes to your credit score. So why is having a good credit score important? Well, with a good credit score, firstly, you have a better chance of your loan actually being approved in the first place. In addition to that, lenders may also offer you better interest rates to borrow money. And you may also have a better chance of borrowing larger amounts if you're dealing with a particularly big financial emergency. However, you can also flip this for a poor credit score. So with a poor credit score, you have a lower chance of being approved in the first place. You may be offered higher interest rates to borrow that money, and you'll have less of a chance of borrowing larger amounts. Now, one common misconception that people often have is about checking your own credit score. And it's important to know that checking your own credit score will not impact your credit score. And it's actually a really useful thing to do. Once you check your credit score with one of these providers, they'll typically update you with a fresh score and a fresh credit report every single month. And if you notice that it's gone down, it will tend to give you some things that you can do to improve your score and give yourself a better chance of borrowing. There's a couple of other reasons why checking your score regularly is important, and we'll get onto those in future episodes as well. So before we finish up today's episode, there's a couple of other things that can actually impact your chances of borrowing that aren't related to your credit history. Now, we'll go into these in a lot more detail in future episodes, but there's a couple of things to think about. First of all, your gambling activity. Now, your gambling activity does not actually impact your credit score, but lenders can see how much you spend and where you spend it when you apply to borrow money. And that includes your gambling activity. So if you're gambling large amounts or gambling particularly frequently, lenders may be slightly reluctant to lend to you. The second one is buy now, pay later, and this became really popular in the pandemic. And it can be a really good option when buying a particularly expensive item like a piece of furniture or a new fridge. And if you can get a 0% APR, buy now, pay later deal, then it can help you to spread the cost of items over time. However, if you miss a repayment, interest can very quickly be added, so keep an eye out for that and make sure you're making your repayments on time. But there's also something called overcommitting, and this is where you buy one thing on buy now, pay later, and then quickly add a couple of other things. And you can find that very quickly you're paying hundreds of pounds every single month towards buy now, pay later. And this can impact your ability to borrow money. Finally, your actual spending habits can impact your ability to borrow. So if you're consistently spending more than you earn, lenders might be a little bit worried about your ability to meet your loan repayments. And so doing a budget plan and kicking out some of the things that you maybe don't need to spend your money on can help you to give a bit more free money every month and improve your chances of borrowing should you need to. So just to recap what we've talked about in today's episode, financial resilience is the most important aspect of your finances, and it can be tested by anything which increases your expenses or decreases your income. And 3 typical things that can test your financial resilience are health issues, job loss, and relationship breakdown. Your best option when it comes to dealing with financial emergencies is turning to your emergency savings because you don't pay any interest on them and they're accessible when you need them. If you can turn to friends and family, that could also be a good option if your savings aren't quite there yet. But if not, giving yourself the best chance to borrow affordably can help you to save money should you need to borrow. And if you do need to borrow money, have a look at your local credit union or the credit union that's linked to your employer to see if they can actually give you a better deal. So thank you very much for listening to today's episode. Hopefully you found it useful and you now know some of the ways that you can improve your financial resilience. If you haven't already, make sure to go back and check out episode 3 on our YouTube channel, as that was our first video episode and also our first interview episode as well. So give that a watch and be sure to subscribe to our channel. Have a great day and we'll see you for our next episode.